Warren Buffett, the Oracle of Omaha, is famous for his investing prowess. Known for his incredible ability to pick winning stocks and his long-term investment strategies, Buffett has become a legend in the world of finance. His company, Berkshire Hathaway, has consistently outperformed the market, making him one of the wealthiest individuals on the planet. But what sets Buffett apart is not just his wealth, but his philosophy of value investing, which focuses on buying undervalued companies with strong fundamentals and holding them for the long term. He's known for his value investing approach. This method involves a meticulous analysis of a company's financial health, management quality, and competitive advantages. Buffett's strategy is to invest in businesses that he understands deeply and believes will continue to grow over time. This approach has led him to make some of the most successful investments in history, including Coca-Cola, American Express, and more recently Apple. Recently, he's been making moves that have surprised some people. Despite his reputation for holding on to stocks for the long haul, Buffett has been adjusting his portfolio in ways that have caught the attention of investors and analysts alike. These moves are particularly intriguing given the current economic climate and the uncertainties facing the global market. Buffett has been selling shares of Apple. This decision has raised eyebrows because Apple has been one of Berkshire Hathaway's most profitable investments. The tech giant has seen tremendous growth over the past decade, becoming one of the most valuable companies in the world. So why would Buffett decide to reduce his stake in such a successful company? Apple has been a winning stock for years. Its innovative products, strong brand loyalty, and impressive financial performance have made it a favorite among investors. The company's ability to consistently deliver high-quality products and services has ensured its place at the top of the tech industry. However, even the most successful companies can face challenges, and Buffett's decision to sell may indicate his concerns about future growth or market conditions. So, why is Buffett selling? There could be several reasons. It might be a strategic move to rebalance his portfolio, or perhaps he sees better opportunities elsewhere. Buffett is known for his ability to adapt to changing market conditions and to make decisions based on thorough analysis and long-term thinking. His actions often reflect a deeper understanding of market trends and economic indicators that may not be immediately apparent to others. He's also been buying up shares of energy companies. This is particularly interesting because the energy sector has been underperforming in recent years. Many investors have been avoiding energy stocks due to concerns about environmental regulations, fluctuating oil prices, and the shift towards renewable energy sources. Yet, Buffett's decision to invest heavily in this sector suggests that he sees potential for significant returns. This is a sector that many investors have been avoiding. The challenges facing the energy industry are well documented, and the future of fossil fuels is uncertain. However, Buffett's contrarian approach often leads him to invest in areas that others overlook. He has a history of finding value in sectors that are out of favor, and his recent moves indicate that he believes the energy sector may be poised for a turnaround. What does Buffett see that others don't? His extensive experience and deep knowledge of the market give him a unique perspective. He may be anticipating changes in the energy landscape that could lead to increased profitability for these companies. Additionally, his investments could be based on the belief that traditional energy sources will continue to play a crucial role in the global economy for years to come. In this essay, we'll take a closer look at Buffett's recent moves. We'll analyze the factors that may have influenced his decisions and explore the potential implications for the market. By examining his actions, we can gain insights into his investment philosophy and the strategies that have made him so successful. We'll explore the reasons behind his decisions. Understanding Buffett's thought process can provide valuable lessons for investors of all levels. His ability to navigate complex market conditions and identify opportunities is a testament to his skill and experience. By studying his moves, we can learn how to apply similar principles to our own investment strategies. And we'll see what lessons everyday investors can learn from the Oracle of Omaha. Buffett's approach to investing is grounded in patience, discipline, and a deep understanding of the businesses he invests in. By following his example, we can improve our own investment decisions and work towards achieving long-term financial success. To understand Buffett's moves, you need to understand value investing. Value investing is about finding undervalued companies. These are companies that are worth more than their current stock price suggests. Value investors look for companies with strong fundamentals. This means things like strong earnings, good management, and low debt. They believe that these companies are poised to perform well in the long run. Buffett is a master of value investing. He's been using this approach for decades, and it's made him one of the wealthiest people in the world. Buffett has been selling shares of Apple. This might seem strange. After all, Apple is one of the most successful companies in the world. But Buffett is a value investor. He's always looking for the best deals. And he may believe that Apple's stock is no longer undervalued. He's also been reducing his stake in Bank of America. This is another company that has been a solid performer. But again, Buffett may believe that there are better opportunities elsewhere. While Buffett has been selling some of his holdings, he's also been buying. One of his biggest buys has been Occidental Petroleum. Occidental Petroleum is an oil and gas company. This sector has been out of favor in recent years. But Buffett clearly sees value in Occidental. He's also been buying shares of SiriusXM, the satellite radio company, and he's been adding to his position in Verisign, a domain name registrar. Section 5. The allure of Occidental Petroleum. So why is Buffett so bullish on Occidental Petroleum? It's a question that has intrigued many investors and analysts alike. Warren Buffett, known for his astute investment strategies and long-term vision, has shown a significant interest in Occidental Petroleum. This isn't just a casual investment, it's a calculated move by one of the most respected figures in the financial world. Well, one reason may be the company's strong cash flow. Cash flow is the lifeblood of any business, and Occidental has been particularly adept at generating it. This robust cash flow allows the company to navigate through economic uncertainties and market fluctuations with greater ease. It provides a cushion that can be used to weather downturns and capitalize on opportunities. You see, Occidental is generating a lot of cash. This isn't just a temporary spike. It's a consistent performance that speaks to the company's operational efficiency and strategic planning. The ability to generate substantial cash flow is a testament to the company's strong fundamentals and its ability to execute its business model effectively. This gives the company quite a bit of flexibility. Flexibility in business is crucial. It allows a company to adapt to changing market conditions, invest in new opportunities, and return value to shareholders. For Occidental, this flexibility means they can make strategic decisions that align with their long-term goals without being constrained by short-term financial pressures. It can use the cash to pay dividends, buy back stock, or invest in new projects. Paying dividends is a way to reward shareholders, and stock buybacks can help increase the value of remaining shares. Investing in new projects, on the other hand, can drive future growth and ensure the company's continued success in a competitive industry. Another reason may be Occidental's valuation. Valuation is a critical factor in investment decisions. A company that is undervalued by the market presents a potential opportunity for significant returns. Buffett, with his keen eye for value, likely sees Occidental as a company whose true worth is not fully recognized by the market. The company's stock is trading at a relatively low multiple of its earnings. This means that investors are paying less for each dollar of earnings, which can be an attractive proposition for value investors. A low multiple can indicate that the stock is undervalued, providing a margin of safety for investors. This suggests that the market may be undervaluing Occidental's potential. When a company's stock is undervalued, it means that the market has not fully appreciated its future prospects and earnings potential. For an investor like Buffett, this represents an opportunity to invest in a solid company at a bargain price with the expectation that the market will eventually recognize its true value. Section 6. SiriusXM and Verisign value in unexpected places. SiriusXM and Verisign may seem like odd choices for Buffett, but both companies fit his value investing criteria. SiriusXM has a strong market position in satellite radio, and it generates a lot of cash. Verisign has a monopoly on the .com domain name. This gives the company a wide moat. It's very difficult for competitors to challenge Verisign. Section 7. Cash is king. The importance of strong cash flow. Buffett's recent moves highlight the importance of cash flow. Companies with strong cash flow are more resilient. They can weather economic downturns better than companies with weak cash flow. Cash flow also gives companies more options. They can use the cash to invest in growth, pay dividends, or buy back stock. All of these things can be good for shareholders. Section 8. Finding value in today's market. It's getting harder to find value in today's market. Interest rates are rising, inflation is still a concern, and the global economy is slowing, but there are still undervalued companies out there. You just have to know where to look. Section 9. Be like Buffett. Advice for everyday investors. What can everyday investors learn from Warren Buffett? Warren Buffett, often referred to as the Oracle of Omaha, has built a legendary reputation in the world of investing. His strategies and principles have stood the test of time, making him one of the most successful investors in history. But what exactly can the average person take away from his approach? Let's delve into some of the key lessons that can help you navigate the complex world of investing. Here are a few key takeaways. Focus on value, not hype. In a world where flashy headlines and trending stocks often dominate the news, it's crucial to remember that true value lies beneath the surface. Buffett has always emphasized the importance of understanding a company's intrinsic value rather than getting swayed by market noise. This means looking at a company's fundamentals, such as its earnings, assets, and growth potential, rather than just its stock price movements. Don't get caught up in the latest fads. The stock market is often influenced by short-term trends and fads that can lead investors astray. Buffett advises against following the crowd and instead encourages a more disciplined approach. By avoiding the temptation to jump on the latest bandwagon, you can make more rational and informed investment decisions. Remember, just because something is popular doesn't mean it's a good investment. Look for companies that are undervalued by the market. Think long-term. One of Buffett's core principles is to seek out companies that are trading for less than their intrinsic value. This often means looking for businesses that are temporarily out of favor but have strong fundamentals and growth prospects. By thinking long-term, you can ride out market volatility and benefit from the compounding growth of your investments over time. Don't try to time the market. Market timing is a risky strategy that even seasoned investors struggle with. Instead of trying to predict market highs and lows, Buffett advocates for a buy and hold strategy. This means investing in quality companies and holding on to them through market ups and downs. By doing so, you can avoid the pitfalls of emotional decision-making and benefit from the long-term growth of your investments. Buy companies that you believe in and hold them for the long haul. Do your research. Investing in companies that you understand and believe in is a cornerstone of Buffett's philosophy. This requires thorough research and a deep understanding of the businesses you're investing in. By focusing on companies with strong fundamentals and a competitive edge, you can build a resilient portfolio that can weather market fluctuations. Don't just buy what you hear on TV or read on the internet. The media is filled with opinions and predictions about the stock market, but not all of them are reliable. Buffett advises investors to be skeptical of media hype and to rely on their own research and analysis. By doing so, you can make more informed decisions and avoid the herd mentality that often leads to poor investment choices. Do your own research and understand the companies you're investing in. Be patient. Patience is a virtue in investing. It takes time to thoroughly research and understand a company, and even more time for your investments to grow. Buffett's success is a testament to the power of patience and long-term thinking. By being patient and diligent in your research, you can identify high-quality investments that will pay off in the long run. It takes time to find great investments. Great investments are not always obvious and often require a keen eye and thorough analysis to identify. Buffett's approach involves waiting for the right opportunities and not rushing into investments. By taking your time and being selective, you can increase your chances of finding undervalued companies with strong growth potential. Don't get discouraged if you don't get rich quick. Investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Buffett's success didn't happen overnight, and neither will yours. By staying focused on your goals and not getting discouraged by short-term setbacks, you can build a solid investment portfolio that grows steadily over time. By following these tips, you can increase your chances of investing success. While there's no guaranteed formula for success, adopting Buffett's principles can help you make more informed and rational investment decisions. By focusing on value, doing your research, and thinking long-term, you can build a portfolio that stands the test of time. Just remember, slow and steady wins the race. The story of the tortoise and the hare is a perfect metaphor for investing. While it may be tempting to chase after quick gains, it's the steady and consistent approach that ultimately leads to success. By staying disciplined and patient, you can achieve your financial goals and build lasting wealth.